Look at the Australian economy in early 2026. Inflation has spiked back up to 6.9%, and consumer sentiment has hit a record low. Shoppers are hurting at the checkout, and they are out of patience. In response, the government is dropping the hammer. On July 1st, a new excessive pricing prohibition law takes effect, directly targeting supermarket margins. Historically, a grocer might simply add 50 cents to a block of cheese to offset their own rising costs. Under this new legislation, that move is now legally risky and publicly toxic. Yet, look at the recent half-year earnings. While consumer confidence crashed, Coles reported a 14.6% surge in supermarket earnings, and Woolworths reported a 9.9% jump in Australian food profits. These companies are surviving the economic crunch because they do not operate like traditional grocers anymore. They have quietly morphed into high-tech data brokers and automated logistics machines. For anyone allocating capital in 2026, this creates a fascinating split. You have to decide between buying into Woolworth's sprawling digital media empire or Coles' relentless physical automation network. To value these stocks correctly today, we have to look closely at how both companies are deploying AI and technology to engineer profits outside of basic food sales. Woolworths is building a model known as surveillance retail. They are shifting their focus to monetizing consumer behavior itself. They start with a massive input of raw data. Right now, there are 10.6 million active members swiping their everyday rewards cards, generating a constant stream of behavioral tracking. They feed that data into their WIC analytics platform and a retail media network called Cartology. This infrastructure allows them to charge food suppliers premium rates for hyper-targeted advertising across their website, app, and in-store screens. This document shows how Woolworths embeds this digital infrastructure into their core reporting to shield it from regulatory scrutiny. Notice how Woolies X, Everyday Market, and Healthy Life are now grouped directly under the Australian Food banner, blending high-margin digital income with standard grocery sales. The financial output of this integration is massive. Their Woolies X division just reported a 78.8% surge in earnings. Selling digital ad placements to a cereal brand carries a significantly higher profit margin than shipping and stocking fresh vegetables. Woolworths is proving that their most valuable profit engine is the monopolization and sale of shopper attention, rather than the markup on the products themselves. Buying into this data ecosystem, however, comes with a steep entry price. Woolworths is currently trading at a normalized price-to-earnings premium of 40.5. That multiple means the market is already pricing in years of aggressive, uninterrupted digital growth. Underneath that premium, there is a heavy structural burden. Their interest coverage ratio sits at just 1.00, meaning their immediate earnings are barely covering their current debt and lease obligations. They also face specific regulatory vulnerabilities. The ACCC is actively scrutinizing how supermarkets use data analytics and loyalty programs to influence pricing. Woolworths gives you a massive growth ceiling through retail media, but at these multiples, it leaves almost zero safety margin if consumer spending or ad revenues begin to crack. Coles has taken a different route, prioritizing physical infrastructure over digital media assets. They have committed $880 million to build massive, fully automated distribution centers powered by Witron and Ocado Robotics. When rival workers went on strike during the Black Friday and Christmas rush, Coles absorbed the volume shock effortlessly because their automated network didn't skip a beat. This physical overhaul is part of an internal strategy they call the Simplify and Save to Invest program, which is the primary driver of their recent earnings beat. This chart quantifies that strategy's success. As the red bar indicates, the SSI program delivered $133 million in benefits in the first half of 2026. Looking at the right, they achieved this through major reductions in waste and highly optimized supply chain efficiencies. Down at the store level, they are rolling out AI-powered smart trolleys and transforming the front-end checkouts to systematically reduce labor hours and clamp down on stock loss. Coles is engineering their profit by stripping away every ounce of physical friction, theft, and human labor involved in moving a product from a warehouse rack to a customer's car. This relentless focus on logistics is generating deep operational resilience. Coles is currently posting a return on equity of 32.9%. Their balance sheet is also far less stressed. They maintain a healthy interest coverage ratio of 3.69, giving them plenty of breathing room to service their debts. For incoming capital, Coles trades at a lower valuation of 24.3 times earnings. That presents a significantly cheaper entry point for the market. The trade-off is straightforward. Coles is lagging well behind Woolworths when it comes to capturing high-margin retail media revenue and building out a sticky digital ecosystem. By choosing Coles, you sacrifice explosive digital upside in exchange for hardcore cost certainty and a robust physical defense against inflation. As an investor staring down a hostile economic cycle, where do you deploy your capital? Map this by weighing valuation safety against the digital growth ceiling. Woolworths sits in the upper left quadrant, a premium play for aggressive investors betting on AI media networks. Coles lands in the mid-right quadrant, the defensive choice for investors prioritizing operational execution. Come July 1st, the new anti-price gouging laws will make business as usual impossible for the entire retail sector. In 2026, profitability is decoupling from grocery sales, shifting toward data monetization and physical automation.